Swayam Prabha. Digital India. Educated India.
Welcome once again friends for the NPTEL module on strategic trade and protectionism, theories and empirics. We are on the week 4 lecture number 20 on clarifying further to the previous content on intra-industry trade and its measures. As we know, there are so many different methods of measuring intra-industry trade, and it has huge relevance for the developing countries context. So, therefore, we are supposed to clarify the nitty-gritties of trade measurement. So, as a background to the understanding of intra-industry trade, we have already discussed in the last class. So, better to recapitulate the discussions further and the first important point for discussion here is that it constitutes the intra-industry trade component constitutes the major portion of the world trade, and also specifically for the Indian context. Now, the empirical evidence since 1970 by different articles suggests that the maximum world trade actually takes place among the similar countries, specially identified by Grobel and Lloyd in 1975. Following the new classical approach of international trade theory or the consequences of the new trade theory discussed largely on intra-industry segment, then the inter-industry segment in the trade patterns. Now, looking at the variety of products in the basket of trade, majorly we are confining our analysis of intra-industry trade in two channels. One is through horizontal approach or another is through vertical approach. So, therefore, it is called horizontal intra-industry trade, or it is called vertical intra-industry trade. Horizontal, where certain attributes are different. Usually the products varieties within the industry or within the farms are more, whereas in case of vertical segment we can characterize those differences by quality. So, higher the quality, vertically the products are actually differentiated. Now, so therefore, we just mentioned here that consumers actually view goods as a bundle of characteristics in case of horizontal intra-industry trade, whereas for vertical they characterized by different quality, quality of the product. And for one such example is personal computer industry, where we have different variety of processors enabled in a single product line called personal computers. So, even in the personal computers are actually varying by quality because of the quality processors enabled in each of the units. Now, the quality is quality preference or the differences in the quality in different countries may be largely corroborated by the income disparities or among the countries or within the countries, technological advantages or disadvantages, differences in endowments of skilled labor or human capital. Now, looking at the horizontal model once again, we consider this to be more relevant for understanding the occurrence of IIT intra-industry trade among the developed countries, and the vertical models for explaining IIT between unequal partners. So, usually what we have already mentioned in the previous lecture, that horizontal models are more relevant among the developed countries. They used to have trade for horizontal different products or differentiated products, whereas among the unequal partners or the countries, vertical models are more relevant. These are the views from different experts. Now, discussing on the differences based on quality or even the characteristics, countries are divided largely, as I just said in the previous point, that countries are actually differentiated by quality. So, and vertical intra-industry trade takes place among the unequal partners. So, therefore, there is a clear argument discussed in the trade theory called North versus South trade differences. North versus South trade differences. North stands for developed countries and South stands for developing countries. Developing countries are largely producers or exporters of poor quality products, as emphasized by Acharya in 2005, Marjit and Raychaudhuri in 1997. We already discussed this in the previous lecture. Recently, the developing countries suffer further due to non-tariff measures by developed countries. In the latest discussions, we have also discussed part of this argument in our introductory lecture, where there are various forms of invisible kind of restrictions raised by the developed countries for the developing country. So, therefore, developing countries products are at risk for exporting in the international market. Hausman, especially Hausman et al. In its 2007 paper, mentioned that countries are actually poor because of their activities. Countries become what they produce. So, even we discussed before on one of the models of trade called emphasized by Professor Jagdish Bhagwati called emerging growth rate. So, where though we discuss about terms of trade, the prices and its attachment in the international basket, and it defines the value of a product. So, price is one of the reflections or one of the representations behind understanding quality of the product. Since quality variation depends on technological advancement and the availability of human capital or the skilled laborer, so the transition from horizontal to vertical or the other way around is actually important for policy implications, especially for the domestic economy or especially for Indian context. Therefore, we are supposed to understand what kind of transitions are there from one variety of IIT to another variety of IIT. So, the share of intermediate goods actually dominates the intra-industry trade globally, as emphasized by Brulhat in 2008 paper and Marini in 2017 paper. Similarly, in Indian experience, it is quite interesting to note because of the fact that though India is famous for high amount of unskilled labor, or the laborers are quite unskilled in Indian context, but its exports are actually not unskilled type. Its export and its value are of skilled variety, especially in the software segment. So, it has larger share of high technology and skill intensive commodities, as also mentioned by Acharya in 2013 paper. So, productivity of export basket at the cross country level, China and India were pointed out to be the outliers in the set of developing countries mentioned by 2006 paper of Roderick. So, so what is important here to note that software export, as I just mentioned, is more important for more crucial for India, and India actually harness the benefits because of the software segments. Also, as mentioned in Roderick 2006 paper, India's XP, which is basically the productivity of export basket, is actually unevenly higher because of the software segments. So, there is hardly any systematic approach yet mentioned which decompose actually the total IIT into different categories like horizontal or vertical, So, following the papers of Bakchi 2014 and which used 6 Indian industries over 1990 to 2013 papers, Srivastav and Maduri paper 2011 during 2000 to 2008 actually discuss about the decomposition of IIT intra-industry trade to horizontal and vertical IITs. One case study may be emphasized here for an anecdotal understanding of horizontal versus vertical IIT differences. If we take the example of passenger car industry, whereas we know that passenger car industry actually assembles variety of segments, variety of small firms are actually attached within the larger industry called passenger car. Now, one important point to be noted here, if a product requires large volumes to be produced for the product to be profitable for a firm, then few firms will actually exist relative to the volume demanded. So, and these few firms actually lead to two-way trade flows. Since large volumes to be produced for this kind of industry, few firms are attached. So, therefore, this leads to two-way trade flow of that specific product, which actually leading to lower IITs. So, lower horizontal IITs, which is quite important to note. The passenger car industry is actually characterized by large minimum efficient scale and high initial cost. And these actually factors lead to industry with few firms, which I have just mentioned. Most of these firms have a differentiated product portfolio that matches the consumer's demand for different varieties. So, this has led to actually very few firms, and few firms is a matter of concern for the understanding of lower horizontal intra-industry trade. If even if most producers have a differentiated product portfolio, their products are often classified as belonging to a specific quality segment, as passenger car industry. So, now concern here is when we are trying to assemble the products to have a segment that will differentiate consumers taste or the products for consumer taste, we will actually end up with very few suppliers. So, there are concerns for lower horizontal IIT. We will clarify what is called horizontal IIT. So, let us discuss once again that what kind of approaches are yet mentioned in different papers. So, Bakchi 2014 paper used unit value dispersion criteria. We discussed this slide earlier in the previous lecture, so I am not emphasizing here much on this. So, this is famously known as, Bakchi paper used the Greenway, Hine and Milner paper GHM approach using a 6 digit level. Now, accordingly the lower vertical IIT or higher vertical IIT is actually classified based on this approach. So, they talked about 6 major Indian manufacturing industries over the period 1990 to 2013. They found that technologically inferior quality products, especially the IVIIT, have been dominant in Indian export basket throughout the period of the study, whereas horizontal IIT and export of high technology goods have gained some momentum after, especially in 2008 from the crisis period, recent crisis period. Now, looking at the latest figures of India's intra-industry trade, now you can easily find out the percentage rise in different years. These are the data from World Integrated Trade Solutions by World Bank, as these are as per the latest figure available in that data set, and there is a gap here because of unavailability of the cases related to intra-industry trade. So, therefore, calculation has not yet been made. Now, so here the chart discusses about number of industries trading in related to intra-industry trade, which is quite important. So, let us move on. We have already discussed this earlier, so I am not discussing further. The famously used technique for understanding intra-industry trade by Global and Lloyd in 1975 as per the following formula. we have already discussed. Let me quickly mention the formula here. Now, this is broadly country from A to B for exports of the ith particular unit or ith industry, and the import of from the another country to country B, I mean A to B, out of the total trade on the denominator. Now, this broadly measures the value of intra-industry trade. As I already said, if it is the same industry, like in the same industry, if it is export only not import, that means we are not actually receiving any import of any content on the same industry, that means import will be 0 and this will be only export. So, export divided export is equal to 1. So, 1 minus 1 equal to 0. So, when it is 0, that means there is no question of intra-industry trade, it is only inter-industry trade. On the other extreme case, when the same industry is actually producing certain output and those output are actually made possible due to 100% imports of the same varieties or the raw materials, that means export is equal to imports through the raw materials. So, this numerator segment is actually 0. So, 1 minus 0 is equal to 1. So, extreme values are 0 and 1. So, 0 stands for no intra-industry trade and 1 stands for full intra-industry trade in the extreme, I mean in this context. So, there are intermediary values and can be emphasized. One of the shortcomings of this particular method, GL method, is mentioned by other approaches, is that I need not emphasize, I have already discussed this, is that it did not talk about the trade balances, because it has taken the absolute value. So, and that too it nowhere differentiated horizontal or vertical approaches of measuring intra-industry trade. To overcome these limitations, one such approach was adopted in 1983 paper by Bockstrand. This is famously called BG index. BG index is actually a bit different than that of the earlier one. It captures the trade imbalances, especially it is not export to import, you can mark the differences. Now, it is specifically differentiating the export from A to B, but here it is export from B to A of ith industry. Now, what is A to B? It is an average measure of export of A, import of A divided by twice of A export plus export of B, I mean it is with the total trade of country B is the total trade of country A out of the total imports in country B, and this side is the total trade basket out of the double of total exports and its average. What is the net flow of goods and the rate at which, I mean the direction at which it is multiplied with that of the average of trade flows. Now, nowhere it is actually creating problems with trade imbalances. So, therefore, the approach is little advanced, and so I mean this is the approach is clearly emphasizing certain direction towards clarifying the trade imbalances issues, which was not which was a criticism to the earlier approach. Another approach mentioned by Balasas in 1986, an index which actually take the sum of the ratios of trade balance to the total trade for each product group and then dividing by the number of product groups. Now, this is clarified through the following approach. I mean it is not exactly similar to the GL approach, neither the BG approach. Now, here it is mentioned like this, instead of taking it 1 minus, it has taken on the numerator itself, it has taken the net imports or net trade from the 1 minus of the net trade. Now, what is this export A to B, which is actually of total trade from A to B, export plus imports, out of the twice of exports, that means what is the volume of trade by doubling the, I mean out of the double of exports times the the rate at which actually the trade is is having certain direction towards A to B. We already discussed this A to B and its direction, and if you are multiplying it, we will find out the x the x direction from A to B of ith industry. After, by following this method, we can find out one thing for sure: the total exports by country A to country B, and total imports A to B is the total imports by country A from country B. As the share of IIT increases, as the share of intra-industry trade increases, the Balasage index as proposed by Balasage in 1986, that BLAB declines from 1 to 0. And similarly, we have already discussed for export direction, the import content can be also followed from the equation here. Now, let us move on to clarify regarding the second limitations of the global and Lloyd index. Global and Lloyd index, which actually emphasize, did not talk about horizontal versus vertical differences, is actually discussed in this approach by A.B.D. Rahman paper 1991. They initially categorized, and they talked about in their 1991 paper the difference between export and import unit value is maximum up to 15%. The product will be said to be horizontally differentiated. When the export or the import value is differentiated by less than 15%, and or if it is exceeding 25%, I mean if it is exceeding 15%, then we will interpret as vertically differentiated, or if it is less than 15%, it will it is as per their suggestions that it should be defined as horizontally integrated trades. Now, from this figure, it is very clear that export and imports are actually overlapping with this portion, and one of the suggestions by certain experts that the minimum of export and import is the value called intra-industry trade. Since this is the minimum one, at this level whatever the amount is there will be considered as intra-industry trade, and so therefore, this is highlighted in this particular diagram. So, it is nothing but twice of minimum of either export or import. This is export import, just make it twice, that is the value of intra-industry trade as a simple pattern of calculating intra-industry trade discussion. So, total trade is equal to intra plus inter, where intra-industry trade is composed of horizontal as well as vertical intra-industry trade. Horizontal intra-industry trade is when imports or exports within a specific industry during a specific time, generally 1 year time period we take, are composed of products of same quality. So, time interval that is studied usually 1 year, as I mentioned, and vertical IIT is then when the traded goods are instead of different quality, where in the horizontal one we are emphasizing on different specifications, where here we are emphasizing the product quality. So, most economists assume that price reflects quality, and so therefore, price is the unit value of measurement. When unit values are outside a specific range, as we initially mentioned as 15%, if it is within the 15% we define as horizontal, if it is exceeding 15% we define as vertical intra-industry, because there are higher overlapping. If the overlapping is less than 15%, it is horizontal. Okay. So, that was mentioned by A.B.D. Rahman in 1991 paper, famously known as GHM approach, Greenway, Hine and Milner approach. They define the index called, they define the index by modifying the GL approach or GL traditions in 3 digit level classifications. The equation is mentioned here, they mentioned with slight changes to it. Now, the changes are, you can follow it off here, the J instead of mentioning like this, instead of defining that, they simply further simplify it. that they have taken the all possible jth industry. What do you mean by J here? J is a jth 5 digit label in product class I. So, if the product class I is defined at 3 digit product class and from country A to B, what is the particular jth industry within the 3 digit classification. So, we can also modify to other digit classification, but once we are sticking to a classification, we have to actually restrict to that while calculating with another countries and its flow of export or import. So, here we actually mention clearly for the jth industry and their connection with the trade. So, nowhere we are actually having the problem with the trade imbalances, because we are only sticking to the jth classification, jth industry or of the ith class. So, therefore, there is no problem at all. Now, the underlying assumption is here is that the relative prices are likely to reflect the relative qualities as mentioned by Stiglitz 1987 paper. So, unit value used as an indicator of the average price of the particular good. So, what do you mean by HIIT? Once again it is, as I said, clarified through unit value of exports. UVX stands for unit value of exports, and there are certain limits given. Alpha represents certain benchmark level, with the variety of instrument mentioned in different papers. They found that unit value of exports is very important for calculation. So, there is no obvious value for alpha as mentioned in different paper. So, usually I mean in different papers the amount value, I mean the alpha varies from 0.15 to 0.25, and so therefore, this indicator is actually frequently used. Now, standard industrial trade classification SITC classification of 5 digit level used in different measures by different expert. They therefore contained with a limit called plus minus 15%. So, therefore, 15%, if it is less than 15%, then it is actually horizontal, otherwise if it exceeds 15%, it is vertical. Now our concern is, what do you mean by unit value? Is nothing but value of the exports of jth industry of ith classification. So, basically the particular value out of the total exports or total exports or total units exports, and here on the numerator we are mentioning the value of that exports. So, that therefore, it is called unit value measurement, unit value dispersion method. Now, based on these indicators facts are derived. Now, we here mention that in order to define vertical intra-industry trade, either the limit as mentioned as suggested by different experts, either it will be less than this limit, or that means 1 minus 0.15, or it will be more than that limit. If either of the direction is not followed, that basically in the intra-industry trade this is the limit, if this is followed, then clearly we define the intra-industry trade to be horizontal. If it is exceeding that, that means we are having with vertical intra-industry trade. Now, further, if that means if the unit value dispersion is exceeding 1 plus alpha, or it is this indeed, then IIT on the aggregate is called vertical intra-industry trade. Otherwise, if it is not, then IIT is nothing but called horizontal intra-industry trade. So, horizontal industry trade is nothing but total trade minus inter-industry trade minus vertical inter-industry trade. Now, I think I have already explained this. Further, to add to the discussion of horizontal versus intra-industry trade, if the trade is classified as vertical, then the GL index we discussed earlier for vertical IIT is equal to the aggregate IIT, as we already discussed. Therefore, this is true since at the aggregate level the IIT is either vertical or horizontal. There are gamut of understanding related to to the clarifications for HIIT and VIIT, emphasized in Stiglitz, Lancaster, Krugman. I need not mention, this is the one I discussed the earlier lectures. Now, bilateral IIT level with respect to India's high income partners, while the same effect is non-significant for low income countries, the VIIT, especially vertical intra-industry dominance HIIT for selected countries like India in the present day's trade. Greenway in 1994 paper calculated HIT and especially for UK context, they similarly found alpha as significant at 0.15, and this is their equation. You may follow it correctly. Only slight change here is they take the change with respect to 1 plus alpha in the denominator. Rest are the unit value dispersion of export and import are same, we have already discussed. Follow the PPTs and find out the differences. I will discuss to point out here that if the trade value is just slightly below the cutoff, that is 9%, even if the varieties are differentiated, such small levels of IIT will not be considered for further analysis. Basically, if it is too low, we need not consider it. Here, I mean the slide is all about emphasizing the GHM approach and FF approach, and there is another approach by Ajar and Elliott. They decompose further IIT in this manner, that 1 plus unit value of exports minus unit value of import. Again they have taken the net unit value to the gross unit value, and they defined the limit also based on different calculations. When the unit value of export exceeds that of imports, the unit value of imports exceeds that of exports by 85%, then the trade could be classified as horizontally differentiated trade. I mean this is based on the AE approach. I think certain other benchmark are given. If the exact benchmark, if it is 0.92 as per this approach within the limit of 0.08, then it is called HIIT, otherwise it is VIIT. You can have a comparison accordingly with all the approaches I have already discussed. Now, last one to be mentioned as part of the as part of the understanding for measuring intra-industry trade is through corrected versus uncorrected global and Lloyd index. It is the simplest method. Here the net trade is subtracted, but there are certain problems of trade imbalances. So, therefore, here instead of taking these, there are some changes. They corrected, they did taken the ratio out of adding this component. So, therefore, this is called corrected one. You just follow it accordingly. We have already discussed these facts. I am not discussing further. You may follow it. This is for your understanding only. Just to mention as a last minute discussion for this particular unit, that India's overall IIT as against rest of the world as per the 2000 and 2015 figure regarding corrected and uncorrected. As per the corrected index, it is actually higher than that of the uncorrected one. Now, similarly, average share of India's major trade partners in the trade baskets can be followed. Australia, India's major trade partners, Australia is highest, USA, China. So far as intra-industry trade is concerned, what are their export share, what is their import share is mentioned, we already discussed. So, and an intra-industry trade index is also given here for developing countries context, for developed countries context and developing countries context, and these are actually based on certain negotiations like SICA negotiations, India, EU, European Union bilateral negotiations. We discuss already. We will be discussing these details in the WTO chapters. So, till then you may wait and then accordingly prepare for the exams. So, with this I think stop here. So, thank you so much.